All right, Kate, I want to start off first with that broader idea here that maybe the way that this market is positioned right now is kind of that coiled spring, and that we maybe could start to see some material upside, I guess, once whoever, I don't know, we won't name him, gets out of the way and lets the market do its thing.
Yeah, I mean, Romain, I think the point is there is a lot of people who are waiting for a positive catalyst. In order for the coiled spring to spring, as it were, we're going to need to see, I think, a couple different buckets of good news. Number one, I think you need to see good news on the fundamental side. Perhaps we'll talk about earnings later. But I think confirmation from people that the worst is over for us in terms of the earnings recession that the U.S. large cap space has experienced over the last 3 quarters. I think the second bucket, of course, is around policy. That is very well known that we want more of an all clear when it comes to policy adjustments in 2024, even if we have one more rate hike ahead of us in 2023. And then I think we need an overall cooling in terms of some of these global tensions, whether it's geopolitics or I think greater belief perhaps in the Chinese growth story that will support a lot of the global multinationals, both in terms of their earnings and activity. So there's a lot of things people are looking at to catalyze taking more risk and taking some of that cash yielding over 5% off the sidelines.
I am curious. I'm glad you brought up China, because this kind of seems like the elephant in the room that we stopped talking about a long time ago. And I know it's debatable as to just how much their economic issues actually affect us in a material way here. But do you think we should be paying more attention to some of their struggles?
I think it's really important to look at China as a more insular economy, much as we've looked at India in the past, frankly. There are many specific drivers to China, whether it's policy or specific consumption or specific regulation. But it is important for global demand of a whole bunch of resources. For example, they have leading companies in parts of the energy transition, electric vehicles and batteries. And it's important to watch what's going on both on the market as well as on the economic side. Will a Chinese slowdown in 2024 kill the overall global economy? I'm not so sure. I think the U.S. is much more important at this point. But in terms of overall demand and in terms of earning streams for a bunch of global multinationals, China still matters a lot.
I want to switch gears here and talk about fixed income, because I'm looking through your notes and this line really caught my eye. Within fixed income, we plan to opportunistically close our underweight in duration. Talk us through that, and what does opportunistically mean here?
Yeah, look, we're not convinced that we've seen the highest rate that we're going to see, for example, on the 10-year. And while I work on a multi-asset fund and I'm an asset allocator, I'm not exclusively a fixed income portfolio manager or strategist. What I would suggest is when we look at the overall fixed income opportunity set, we see more kind of in the short end. We've been underweight duration. We're obviously taking advantage of cash rates at this point. And we're just not convinced at this point that adding to longer duration assets is the right call. In fact, I kind of like some of the barbell between the short end in the belly of the curve as well as the equity space.
Yeah, and that's what I wanted to do, sort of draw the line between what's going on in the fixed income market, in the treasury curve, and what opportunities that's necessarily creating in the equity space. How are you thinking about that relationship?
Yeah, I mean, Katie, this has been one of the biggest debates, is like how much has higher rates really impacted the corporate sector? And the truth of the matter is, for the long
Oh, it appears that we lost Kate Moore for the time being, which is a bit of a bummer, because it feels like that's really the big conversation in markets right now, just not how high yields can go, but what does that mean for equities?
Yeah, absolutely. And I mean, look, is the idea, though, too, that investors, and I think, Katie, I think we have Kate Moore back if you want to finish that thought.
Yeah. My thought was basically that the higher rate environment has not had as much of an impact on the large and mega cap space as some would have expected. Some of that is because we know these companies have termed out their debt. Some of that is because they have a lower proportion of floating rate. But a lot of it is because these companies have gotten disciplined over the last 10 years and have really been financing a lot of their CapEx, a lot of their hiring, a lot of their expansion with free cash instead of debt. So there's been a mentality change in addition to an overall structure of debt change across the large cap space. I think I think that's going to be an okay environment for 2024. And you've seen the market punish small caps and companies that are highly levered and are reliant on floating rate debt.
Kate, I think that's so interesting because the conversation around tech, especially a couple of years ago, is that these are the companies that are going to be more vulnerable in a higher interest rate environment because of those long duration cash flows. But I feel like we've really had to have a real rethink of that logic for that reason that you mentioned, that these aren't companies that are necessarily having to tap the debt market with these higher rates right now.
Yeah, that's absolutely right. And I think we need to look at companies today and really take a good look at each of their own balance sheets, each of their own financing, each of their own cash flow prospects, instead of saying kind of with a knee-jerk reaction, higher policy rates are a bad thing for higher multiple or growth companies. It is a really kind of more of a mixed bag. Similarly, we've seen some of the value type companies, things that are trading at a discount to the market, stay cheap for longer periods of time because they haven't done the work on their balance sheets or their debt structure, and don't have the prospects for growth in a more moderate economic growth environment.